Hey there YouTube. So in this video I wanted to cover the U.S. federal corporate tax rules and how they differ when we're applying them to a U.S. domestic corporation and then a foreign corporation. So I've got just one slide in front of us. There's a lot of line items. I got some examples in there, but I think this summarizes fairly well the different treatment between the two. So let's just start at the top and work our way down here. So generally speaking, how are domestic corps taxed, right? So a domestic corporation is a corporation formed in the U.S. and they're taxed on their worldwide income from whatever source derived. And this is similar in treatment to U.S. citizens, right? So if you're a U.S. citizen, it doesn't matter where you get your income, right? It could be foreign source, it could be U.S. source. You've got to report all of it on your tax return and you pay taxes. And that even applies if you're a U.S. citizen and you don't even live in the U.S., right? If you live abroad on a full-time basis, let's say you live in Germany and you have a job there and you live and work there, that's foreign source income, but you're still paying U.S. taxes on those earnings. Domestic corporations are kind of the same treatment, right? If you've got a corporation formed in the U.S., and this is a domestic corporation is defined in 7701A4. That corporate entity is going to file a tax return every year, report all of its income from whatever source derived, and it's going to pay taxes, right? So Section 11A states that a tax is imposed for each taxable year on the taxable income of the corp, and 11B provides that the amount of tax levied is going to be 21% of taxable income, and that's what the code section says as of 2021. If you're watching this video later on and the rates have changed, well, you'll see the rate change in 11B. So how are foreign corporations taxed? Well, a foreign corporation is a corporate entity that's not domestic, right? Makes sense. So if you have an entity, if you look up the definition in 7701A5, if you've got a foreign corporation that's formed in a jurisdiction that's not within the United States, then it's a foreign corporation. Section 11A states that tax is imposed for each taxable year on the income of every corporation, right? So notice in this Section 11A definition, it says every corporation here. It doesn't distinguish between U.S. or foreign, right? But then later on, if you're still reading in Section 11, you get 11D says that in the case of a foreign corporation, the tax imposed shall apply only as provided in Section 882, right? So what is Section 882? In Section 882A1, a foreign corporation engaged in a trade or business within the U.S. shall be taxable under Section 11 on income that is effectively connected with that trade or business. So this is the big difference here, right? The Section 11 states that every corporation is subject to tax, but if you've got a foreign corp, you're only paying U.S. taxes on U.S. source income that's effectively connected with a U.S. trade or business. Okay, so now the question is, well, what is that? What is a U.S. trade or business? Well, let's look at two examples here, and hopefully this will illustrate the point for us. So John, he's a citizen and resident of the Caymans. He forms a Cayman Islands Limited Company, right? This is going to be a foreign corporation, right? If we look up 7701A4 and A5, we'll see that the Cayman Islands Limited Company is going to be a foreign corporation. And he's operating this business as a marketing consulting company. So John is a customer in New York, and that pays his company $10,000 for marketing, consulting, research. So John's company, it's based in Cayman. It does all the work from Cayman. It doesn't have any U.S. offices, no U.S. employees, and no workers that have to travel to the U.S. Under this fact pattern, the Cayman Islands Limited Company is a foreign corp, but it's not going to be subject to tax under Section 11 because it's not engaged in U.S. trade or business and it doesn't have any U.S. source ECI. Right, so given this limited activity in the U.S., no U.S. trade or business, no U.S. source ECI. And so let me think, what am I trying to, so the foreign corporation, having U.S., that's what I want to highlight. Having U.S. customers alone is generally not enough to be engaged in U.S. trade or business, right? You got to have more nexus there. So that's why in this example, John might have a client in the U.S., but that's not enough to make a U.S. trade or business. So let's look at this one here where he might have a U.S. trade or business. So John's company in the Caymans hires a U.S. employee, and the U.S. employee has to go to New York, works directly with the client. Under this scenario, the Cayman entity is likely engaged in U.S. trade or business, right? Because it's not only got the U.S. customer, but you have an actual employee on the ground, right? Going to the client, doing work within the U.S. So the physical presence of this U.S.-based employee likely creates a U.S. trade or business, and now you have U.S. source ECI. So under this fact pattern, the Cayman Islands is likely going to have to file an 1120-F, right? The 1120-F is a corporate tax return for foreign entities. Domestic corps file just a regular Form 1120, but in this case, they'd file an 1120-F. It would report its U.S. source ECI, and then it pays federal corporate income taxes. So two simple examples, how this point is illustrated, but the rules, if you're looking for actual sourcing on how do we come up with the actual tax code and the rules, you're looking at these sections up here, right? So we're looking at section 11 and section 882. So that covers it for this slide and this video. I hope you found that was helpful. If you have any questions, please leave me a comment below. Happy to answer any I can. And I look forward to seeing you again on the next video. Thank you.